Today I want to talk about the investment concept of diversification. I think diversification is best summed up with that old cliche, don't put all your eggs in one basket. What I mean by that is that if you've got too few assets in your portfolio, you become more susceptible to greater volatility or the ups and downs of the market. By widening the base, adding more assets in, what it allows you to do is reduce the risk of your portfolio and not be so susceptible to greater volatility. Let me explain in more detail by using a few slides. What we're looking at here is the risk-return spectrum, and down the bottom left-hand side you can see cash. And what you tend to get from cash is a low or no risk asset, but a lower potential return than other asset classes. As you move up, you go through government bonds or fixed interest type investments, hybrids which sit between fixed interest and shares, up through property, and then shares being Australian and international. The question we often ask is how much risk is right for you? What we need to do is assess your financial situation, have a look at your goals, time frame, expectations and knowledge, and then have a look at what type of risk profile you are, which could be from defensive to moderate, or it could be up to growth and aggressive or balanced. The main types of asset classes we look at: in the growth category, we look for longer term, higher risk, higher growth type assets, and these tend to be your Australian and international shares and your property listed or global type assets. In the defensive basket, you're looking at assets that tend to be shorter term, lower risk and lower growth opportunity, and these are fixed interest, Australian and international, or cash. If we look at the returns of asset classes year by year, you tend to see quite a variation in what returns well and what returns not so well. If we have a look at 2006, we can see that the best return for the year was international property. The worst return in that year was international fixed interest. And if we look at 2012, the highest returning asset class was actually international bonds or fixed interest, and the lowest returning asset class was Australian shares. So it does tend to vary over time. So there it is, diversification. Keep an eye out for more in my education series.